Here I am, Samarth Shah, Baniya welcoming you. So, talking about right now is how Marathon Management AMC of London, which is managing $50 billion of funds, is making money over past 2 decades by investing in business cycles. Their core competency lies in getting alpha and generating alpha through ups and downs of the business cycles. So what they properly look at is, and they've all documented in their book called Capital Returns, Understand the Business Cycles. They are trying to tell us that, see, you have to find a great company, which in itself would mean that you are going to find this. So this is a contrarian strategy, of course. This is not a strategy where you invest in a company which is already growing. No, you find all those sectors which are lethargic, which are not doing good. It could be some of sugar, it could be textiles, it could be all of these sectors which are dead right now. You just have to ask them, are you even alive? And what you need to look at is, you don't need to look at all the financial metrics which conventionally we follow. That is ROE, ROIC, EPS. All of them will be negative or very poor. It will be lower than 5%. EPS would be negative. There is no hope there. But you need to look at just one or two things. That this kind of businesses, what they'll go through is that the company would eventually turn out to make a higher return if that company is currently, you find them at the bottom of the cycle, right, and ride them till the top of the cycle. So that is the way you buy them at the bottom of the cycle and sell them here. But then which company to buy at the bottom? That is the main question to ask. So I'll try to answer that in a very simple manner, and what even Old Bridge Capital's fund manager Kenneth Andre says, that company at the bottom would be still an industry leader, would have most of the profit pools, and say the profit would be in just probably 2-3 companies, and all these rest of the companies are making losses. So the profits would be concentrated only in top 2-3 companies. You'll also see that second part is, you'll also see that these companies go on acquiring certain companies. And why is that? Because right now if you go to see, they are acquiring company and they are buying it at dirt cheap valuation. They are buying at a very low price. Okay, so what they're getting is a higher market share at a lower capital employed. So they're putting a very small amount of additional money to generate that market share, and slowly and steadily, because of demand or because of supply cutting down, because the people are making losses, right? I said that. So what you see is supply getting lesser and lesser, the demand supply scenario coming into sanity, the pricing power coming back to these players, the profitability coming back, and you see that player rising. But you need to be really patient with this. It might take 3, 4, 9 quarters for these companies to start generating money. And one important thing to look at in this kind of strategy is that you need to know that these companies are not fancy. So you need to have that guts to not look at stock prices, because they won't move every day. They won't really move. So that is it. Yeah, thank you.